IAS 8, Accounting Policies, Changes in Accounting Estimates and Errors, Video 2. Where an IFRS is applicable to a specific item, you will determine the accounting policy for that item with reference to the IFRS. But in the absence of an IFRS for a specific item, management will need to apply judgment to develop their own accounting policy to account for that item. The accounting policy needs to result in information that is relevant and reliable. IAS 8 is one of the oldest standards and therefore still refers to the qualitative characteristic of the old framework. In making the judgments to determine an accounting policy to apply to an item, management can use different sources. They can have a look at other IFRS of related items or refer back to the framework. They can also look at pronouncements of other accounting standard setting bodies or at accounting literature or accepted industry practices. An accounting policy would need to be selected and applied consistently for similar items unless an IFRS requires or permits different categories. Then that accounting policy would need to be selected and applied consistently to each category. An accounting policy should not change regularly because we would like comparability. Comparability within a specific entity over time, but also between different entities. Accounting policies can only change if it is required by an IFRS or if changing that accounting policy would result in financial statements that provide more reliable and more relevant information about a specific item. It's important to note that if there are new transactions or transactions that substantially differ from previous ones, this is not a change in accounting policy. If we think about IAS 16 as an example, IAS 16 has a choice between the cost model and the revaluation model. That is the accounting policy choice. That accounting policy can change and an entity can go from the cost model over to the revaluation model. This change in accounting policy is not addressed in IAS 8. IAS 8 says that you do not need to apply the normal IAS 8 requirements. You can apply IAS 16 when changing from the cost model to the revaluation model. If an IFRS requires a change in accounting policy, you will look at the transitional provisions in that IFRS to determine how to account for the change in policy. If it is a voluntary change to provide more reliable and relevant information, IAS 8 says that the change in accounting policy needs to be applied retrospectively. That means go backwards. What that implies is that you need to apply the new accounting policy to all transactions and events and conditions that have happened already as if this new policy had always been applied. If we have a look at the timeline, if you change an accounting policy during the current year, you would change and base the current year on the newest policy, but you would also need to go back retrospectively and change your comparative amounts as if this new accounting policy had been applied in the comparative year. But you need to go back even further than that to all years, as far back as possible, and retrospectively adjust as if the new accounting policy had always been applied. IAS 8 says you will go retrospectively unless it is impracticable to determine the period-specific effect of the change or the cumulative effect of the change. The term period-specific effect refers to the effect of the change in policy on a specific period. The term cumulative effect refers to the combined effect, a cumulative, added together, the effect of the change on more than 1 year together. IAS 8 has different guidance on how to apply a change in accounting policy if it is impracticable to determine the period specific effect, and it also has guidelines on how to treat the change in accounting policy if it is impracticable to determine the cumulative effect of the change. For FRK 201 purposes, there is a separate handout dealing with impracticable situations. Please look at the examples in that handout to understand what we mean with impracticable and how we would account for a change in accounting policy where it is impracticable to go backwards retrospectively as far as possible. The bottom line of IAS 8 is you do go back retrospectively as far as you can. IAS 8 also deals with the disclosure of a change in accounting policy. The disclosure is done in a separate note titled Change in Accounting Policy. The first thing to disclose is the nature of the change. For FRK 201 purposes, there can be changes in accounting policies in IAS 16, as we already said, from the cost model to the revaluation model, but that is not done in terms of IAS 8. It is done in terms of IAS 16. Another change in accounting policy we deal with in FRK 201 is IAS 40, investment property, going from the cost model to the fair value model, not in the other direction. The next change we will look at in FRK 201 is IAS 2, inventories, going from weighted average to first in, first out, or from first in, first out to weighted average, in either direction. In the disclosure, in the note, you need to provide a reason why this voluntary change will lead to more relevant and more reliable information. Then you need to give monetary amounts, the effect of the change. And you need to show that effect for the current year as well as each prior period presented in the financial statements. For that effect, you need to show the increase or decrease of each financial statement line item that was changed because of the retrospective application of the change in accounting policy. It is important to note the wording, each financial statement line item. Something like depreciation changing is not a line item. Which line item would include the depreciation that was changed? You need to show the effect on the line item, line items on the face of the financial statements. You also need to show the effect of the change on basic and diluted earnings per share. Earnings per share is a topic that we do later this year. If you could not go retrospective because it is impracticable to do, you need to disclose the circumstances that existed that made it impracticable. And you also need to tell your users of your financial statement how far back could you at least go? From when did you apply the change in accounting policy? Any financial statements of subsequent years do not need to repeat this disclosure.